All right, let's talk about one of the most famous sayings in all of finance, this idea that diversification is the only free lunch in investing. But, is it really free? Today, we're going to dig into the math, we're going to look at the psychology, and we're going to find out what the real price of this so-called free lunch actually is. So let's start with the big promise itself. Why does everyone talk about this? What's the big deal? Well, it all kicks off with this really powerful statement from an absolute titan of finance. And there it is. This is the quote from Nobel Prize winner Harry Markowitz that started it all. It's basically the bedrock of what we call modern portfolio theory. And what he's saying is, there's a way to get something for nothing in the markets, a real statistical edge that anyone can use. I mean, that's a pretty bold claim, right? But what does he even mean by a free lunch? Well, in finance, a free lunch isn't about getting free money. What it really means is something almost more magical. It's the ability to lower your portfolio's risk, all those gut-wrenching ups and downs, without having to sacrifice any of your expected return. Think about that. You get all the potential upside with less of the downside drama. That's the powerful idea here. And that, of course, brings us to the core question we're tackling today. I mean, if this advantage is so powerful, so easy to get, what's the catch? It sounds a little too good to be true, doesn't it? Is this lunch really free, or are there some hidden costs that aren't on the menu? To figure that out, we've got to pop the hood and look at the engine that makes this whole thing run. And that engine, well, it's pure mathematics. Don't worry, it's not as scary as it sounds. Okay, so the very first thing you have to get is that not all risk is the same. You can basically split all investment risk into two big buckets. Over on the left, we've got unsystematic risk. This is stuff that's specific to one company, like a terrible CEO gets hired or a new product just completely bombs. And here's the key. You can control this. You can diversify it away. But on the right, you've got systematic risk. This is the big stuff, recessions, interest rates going crazy. It hits everybody, and there is just no avoiding it. So you see the difference, right? You can protect yourself from one company making a bad call just by owning other companies. But a global recession? There's really nowhere to hide. Diversification is this incredible tool for getting rid of that company-specific risk, but it is completely powerless against the market-wide stuff. So how exactly does diversification perform this magic trick of getting rid of risk? Well, it all comes down to one secret ingredient. The absolute key to this whole concept is a little statistical thing called correlation. This is what actually creates the free lunch effect. Correlation just measures how two different things move in relation to each other. So if the correlation is a perfect +1, they're like identical twins, moving in perfect lockstep. You get zero benefit from that. But as that number starts to drop, that's where the magic happens. If their movements are totally unrelated, a correlation of 0, you get a huge reduction in risk. And if they happen to move in exact opposite directions, a correlation of -1, well, that's the holy grail. That's a perfect hedge. And this right here is the beautiful, almost unfair mathematical advantage. Figuring out your portfolio's expected return is simple. It's just adding up the average of what you own. But your portfolio's risk is totally different. Because of that correlation piece in the math, the total risk is actually less than the sum of its parts. You get this huge geometric benefit to your risk without even touching the simple math of your return. That, my friends, is the free lunch. But this is where the story takes a little bit of a turn. We've seen how the lunch gets made, but now we got to talk about the first item on the bill. Because even with all that mathematical wizardry, there's a level of risk you just cannot escape. So here's the bottom line. Diversification has a hard limit. You can own 100 stocks, 1,000 stocks, stocks from every country on Earth. It doesn't matter. You can never, ever get rid of that market-wide systematic risk we talked about. There is a baseline level of risk, a systematic risk floor, that you have to accept just to play the game. And we actually have a name for this unavoidable risk. It's called beta. Beta just tells you how much your portfolio tends to move when the overall market moves. If you have a beta of 1, you're just riding the market wave. And here's the crucial insight. This is the risk you get paid to take. The market rewards you for taking on risk you can't avoid, but it offers you absolutely nothing for taking on a risk you could have easily diversified away. And here's the really scary part about that risk floor. During a huge crisis, think 2008, a global meltdown, all those nice, low correlations between different assets, they tend to spike and shoot up towards +1. Suddenly, everything is falling at the same time. which means the benefits of diversification tend to disappear right at the exact moment you need them the most. So, the first price of the lunch is that you can't get rid of all the risk. But there's another cost, and this one's a lot sneakier. It's not something you're going to find on a spreadsheet. It's measured in human emotion. This is the psychological toll. Let me ask you a question that I think gets right to the heart of this. Why is it that a diversified portfolio almost always feels like you made a mistake when you look back on it? Because this is the feeling, right? In any year, there's always going to be some hot stock or hot sector that just blows everything else out of the water. And in hindsight, that looks so obvious. So the feeling you get isn't pride in your solid, sensible 12% gain. It's this nagging, painful regret that you missed out on that 75% rocket ship. This is the real price of diversification. It's the constant, low-grade pain of owning something that's not doing well. It's that feeling of regret, or what we all now call FOMO, fear of missing out. It's fighting that voice in your head that's screaming, sell the boring stuff and just buy the winner. And it's the incredible day-in, day-out discipline it takes to ignore all of that noise and just stick to your plan. Believe me, that is a very, very real cost. So, we've seen the math, we've seen the hard limits, and we've seen the heavy psychological price. Which brings us, finally, to the big question. When all is said and done, is this lunch even worth eating? Well, this chart really sums up the core benefit. If you own just one stock, you're carrying all the risk. The job of diversification is to come in and surgically remove that uncompensated company-specific part, the part you get zero reward for. It leaves you only with the market risk you actually get paid to take. It's about getting rid of the stupid risk. So here's the final verdict. No, the lunch is not truly free. Not even close. You definitely pay for it. You pay in fees, you pay by accepting that there's a risk floor you can't get past, but most importantly, you pay for it with the heavy mental burden of discipline and regret. And yet, even with that hefty price tag, it is still one of the most valuable, most important meals any investor will ever have. So how do you make sure you get the most out of it? Well, first, focus on correlation. Don't just buy more stocks, buy things that move differently. Second, make your discipline automatic. Set up rules for rebalancing so you're forced to sell what's high and buy what's low. And finally, just acknowledge the floor. Accept that market risk is simply the price of admission if you want to earn market returns. And that leaves us with one final thought. The free lunch of diversification has a price tag, but it's not measured in dollars. It's measured in your own discipline. You now know exactly what it costs. The only question left is, are you willing to pay?